Now, do you still need insurance as you approach retirement? In those last 5 to 10 years before retirement, you've accumulated a lot of assets. Do you still need insurance coverage? That's an important question that we want to answer in this video. Now, my name is Owen. I'm an advice-only financial planner, a CFP, and I'm the founder of advice.ca. I do not sell products. I don't sell insurance. I don't manage investments. What we're looking at here in this video is purely, do we need insurance from a risk management perspective? We just want to understand, do we still need insurance later on in a plan right before retirement to protect against the risk of a partner passing away unexpectedly? Now, for many Canadian households, term life insurance is a very important tool to manage risks as you're in the accumulation phase. If you have dependents that rely on your income while you're working, it's a very important tool to make sure that if something were to happen, that your dependents and loved ones are still protected financially if they can no longer rely on your income. But what if you're in your 50s? What if you're approaching retirement? You've got quite a bit of financial assets saved up. You don't have as large a mortgage. Your kids might even be out of the house already. Do you still need term life insurance at that point? It can be hard to understand what are the impacts of passing away earlier in your plan. So even during the accumulation phase, it can be hard to contextualize all of the different changes that your surviving partner or spouse will experience if you're no longer around. And that can be very difficult to model out even for retirement planners. So what we want to do is we want to understand what are the changes in Canada Pension Plan, no longer having old age security, what sort of losses of income are we expecting, how does that affect the accumulation phase, those last 5 to 10 years before retirement. In our recent webinar on survivor scenarios, we looked at an example, a case study with a young couple in their 30s. They had 20 years of term life insurance, but we also looked at what were to happen to them if one of the partners were to pass away after the term life insurance expired. So what if in their early 50s, one of them were to pass away unexpectedly? What are the impacts to their retirement plan? Now, you might be surprised at the exposure, the risk that they had. Even though they were so close to retirement, their mortgage was much smaller, they had much more in terms of financial assets, but there was still a risk there in those last 5 to 10 years before retirement. Now, we're going to look at a younger couple, but this might impact you if you're still in your kind of 40s, 50s, you're still in that accumulation phase. If you've got another 10 years of accumulation, we're going to show you how, even if you have some term life insurance, that still can be a risk depending on how much you still require that employment income to help you reach your retirement goal. So in this case, let's take a look at who we're working with. So this is Alex and Emma. So Alex and Emma, they're in their mid 30s. I think we've got family, we've got a home purchase here coming up. So no real estate, they're purchasing a home, they've got a mortgage. And let's take a look at their insurance information. So I think we're adding this insurance. Let's first start off with their insurance needs analysis. So this can be interesting. This is sort of a broad, very basic insurance needs analysis, but takes a look at your, age, your years until retirement, and your after-tax income, and gives us a sense of how much we might need to cover that potential loss of income in a survivor scenario. So gives us a rough ballpark of what sort of maybe term life insurance we might need to sort of help prevent or protect against that risk. So we see here Alex requires, because of higher income, requires about 1.2 million in term insurance. Emma needs maybe about $1 million in term insurance. We've added that to the plan. So in insurance, we've got $1 million here. We've also got, I think, some employer coverage, so 250,000. So combination lets us hit that 1.25 million that we were looking for. And then Emma's got 875,000 plus an employer policy for 100,000. Now, it's important to highlight that the employer policies will continue, but these term policies are going to end at some point. So they'll end in 2044 before Alex and Emma are actually at their retirement target. So they're in their mid 30s. These term insurance policies will end at kind of 55, mid 50s, but they're still aiming to retire it at 65. So there's still a 10-year gap there, and we'll see how that can be an impact. Okay, so let's take a look at the projections. We've got our base scenario. So this one looks quite good. So they've got that home purchase. They're building up their retirement assets. They'll retire with about 1.1 million in today's dollars. Home's paid off. Looks like a fairly healthy retirement plan. So as a base scenario, that looks good. That's not a problem. Success rate's 85%. But again, we're so far out that that's again, that's a good benchmark to aim for and fairly reasonable spending. So spending 92,000 a year, they've got their debt payments, not saving a ton when they're first paying off that mortgage, but that's okay. They kind of catch up later on. So overall good plan. But let's look what happens if one of them were to pass away earlier on, and what are the impacts here? So, a couple things to highlight. We've got a huge insurance payout here. So, if Alex were to pass away, or Emma in this case were to pass away, we've got close to $1 million being paid out. That, of course, gets saved. We need to invest that money. We need to use that for mortgage payments or for living expenses. But what's interesting is it's not quite enough. So even though the needs analysis would suggest we needed that close to $1 million, we can still see we're a little bit short. We did have about $1 million at retirement. Now we've got 500,000. A couple impacts here. So one, we're losing all of Alex's CPP and OAS in the future. So that's a big impact. There's some survivor benefits. So if we go down to the table, so sorry, if Emma passes away, we're getting a bit of a survivor benefit. So even if you're younger and partner passes away, 30s, 40s, 50s, you're going to receive something, but it's not going to be nearly as much because there's not as many years of contributions in this case. So fairly small CPP survivor benefit. And when we get to retirement, that leads to a fairly big impact on the overall plan. So again, we might want to look at different options here. It could be reducing spending, could be additional insurance. So it just depends on what they want to focus on. But in this case, if we still wanted to have that $1 million insurance policy, we'd have to cut spending by about, $20,000 a year. So we did the same thing down here in others. We reduced the spending as of that survivor scenario. So this could be a factor. Now, what's interesting is that if we look at even a later life expectancy, so let's say that Alex were to have a survivor scenario, so Emma were to pass away, but it happens after the term policy expires. Here we're getting the workplace coverage, but we've lost that sort of $1 million policy, 875,000. So again, we see a fairly big impact to the plan. Even though they've had a lot of time to accumulate those assets, they're not quite at retirement yet. So, even in that situation where, you're 5-10 years from retirement, there still can be a need for some sort of insurance coverage in that case, or a bigger reduction in spending. So sometimes we see that as we're building retirement plans for couples. If we don't have quite the retirement assets that we need and we're still relying on the next 5, 6, 7, 10 years of employment income, that could still be a factor within your plan. So think about survivor scenarios, in retirement, but also the lead up to retirement as well. Even in this case, once that term policy expires, we're in a bit of a tougher situation as well. Now, if you'd like to see how different survivor scenarios might affect your retirement plan, we recommend signing up for advice. Advice is just $9 a month. You get full access to the platform to create your base retirement plan, survivor scenarios, and you get access to our community for support, as well as the bi-monthly webinars that we do as well. Thanks so much for watching. I'd love it if you like and subscribe, and we'll see you at the next one.